What's up guys, Riz here. Thanks for tuning in. Today's video is an important one, and man, do I have something in store for you guys. So stay tuned. Let's get things going. First and foremost, GameStop, right? What has been going on? What is going to happen? Is there a precedent for this? Do you have questions? Everyone does actually, but you know what? Let's continue on. It's something that is mind-boggling and something that we haven't seen in many years. This has happened before, and I'll explain on that in a bit. But before I do, let's kind of decompartmentalize what's happened with the stock. Where has it been? What's occurring now? What's causing it, right? So how do we do that? Let's go to the weekly chart for GameStop. All right. Every time I look at this candle, I just lose my breath a bit. It takes a lot to make me do a double take, but this is one of them. So a weekly chart of GameStop. I've zoomed out all the way back to initial listing in around 2002 and take a look at how it's moved in a broader sense, right? About $3, $4, all the way up, hitting a pretty much before this week, an all-time high of around $60 to $63. Okay, that's the all-time high back in about 2007. Then the markets plunged, it dropped, and just moved relatively sideways month after month after month, year after year, with a high about $30, $32 or so for many years. What happened in 2013, you see a nice pull. Again, the long term support being about $60 a share kind of kicks in, and then it kind of starts making its descent from there on out. And up until recently, let's just be fair, maybe not a $5 stock, but let's just say a $20 stock, okay, as of recent. Now, let's decompress, zoom in again, and see what has occurred just this year. Okay, I cannot believe it. Since the beginning of 2021, January 4th was the first trading day. This thing traded about $18.50. Okay, so to put things into perspective, $18.50 roughly, let's just say $19. Okay, January 4th, the first trading day. Where did it close now? About $350. Okay, it's dropped a bit, in after hours, but take a look at this. This is 23 days. Okay, 16 bars, aka 16 trading days, but 23 days, remember weekends. That is over a 1,700% gain. Think about that. In approximately 3 weeks, little over 3 weeks. I have never seen anything quite like it firsthand, let alone been on the opposite side of it, and I'll go into that in detail. But is it a sight to behold? Almost anyone and everyone and their grandmother is talking about it, it seems. The media, whether it's financial media or just regular old news, whether it's online websites, bloggers, whether it's social media, obviously Reddit, Wall Street Bets, this is the stock. And what is GameStop, in case you're wondering? It's a brick and mortar store that obviously for nearly 20 years was selling video game consoles and video games. Okay, why did the stock drop? For obvious reasons. You don't have to be a genius to know that although video game industry has grown exponentially over the last decade, 2 decades, GameStop has been floundering. It's been dropping, as you saw, right, up until recently. Why? Because guess what? Everything has been going digital. Obviously, the 2020, the pandemic, COVID didn't help, right, with malls shutting down. GameStop locations are mostly in malls, kind of strip malls and areas like that. And guess what? No one's going there also because people are downloading their games, whether it's on Xbox or PlayStation. They're downloading their games digitally, okay, from the store, online stores, from these consoles. Plus, even if they're on PC, they're using Steam and so on and so forth to get the games. No one's going in there buying physical copies as much anymore. Well, I don't need to go into detail to tell you that's not good for business, especially when you have many stores closing, when you have a pandemic, people are not, really coming in to buy things in the store. So you're thinking, well, why this stock all of a sudden? Why not Apple? Why not, Microsoft? Why isn't that up 1,000%? Right? These companies are generating immense cash. We know them. They're amazing. They're fundamentally sound. They've been here for, 30, 20 years and longer. Why not those? Because of the short percentage of the float. What's the float? The amount of shares that are out there in the market that are able to be traded. Well, GameStop, relatively speaking, has a smaller share float that's able to be traded in and out between all different amounts of people in the market. But the important part of that is the percentage of those shares, okay, that are available to be traded is held short, and that percentage is over 100%. Depending on where you get the numbers from and the source, some sources say it was closer to about 150%. Some say it's currently 140% short. I think it's probably, 100%, a little bit over, okay, with what's happened in the last few days. And this leads me into talking about a short squeeze. I'm not going to go into the details, but ultimately a short squeeze is people that have bet, okay, they're shorted the stock, institutions, Melvin Capital, the hedge fund that obviously has been in the news and on Wall Street Bets and Reddit. There's also Citron Research, Andrew Left, Citron Research, a prominent short seller who also went on and said that he was short the stock just a few days ago. And guess what? These people have been squeezed. Why? Because they've shorted the stock, they've held the stock short, and when buying comes in, remember, when you short, you can lose theoretically an infinite amount of money. Okay? When you buy something, the max you can lose, okay, is 100%. If you buy something for $500, the lowest it can go is zero. Right? That's it. You've lost your entire investment of 100%. On shorting, you can lose multiples of that. Okay? Theoretically infinite. How? I'll explain to you in a moment. But ultimately, this is a self-fulfilling process. People keep buying, all right? It effectively fuels more buying. And people that are short are now losing, their entire investment, a multiple of their investment. How do they close the trade? How do they book the loss? By buying back the share. They have to buy back, okay? Because the shares are borrowed. So when they buy back shares, it fuels further buying, right? When investors and individuals that are on Wall Street Bets or wherever, okay, they're buying call options, market makers are forced to hedge and buy shares, especially when they're really, really in the money, okay? And that's as far as the strikes go. But again, that's options. I'm not going to get into the gamma squeeze stuff and all that. But ultimately, this has been a perfect storm. When you have massive amounts of people, massive retail-driven pump, okay? I'm not going to use the word manipulation or anything like that because that's not really the right word. It's not, in the spirit of what's happening. It's just a massive overcrowded trade on the buy side. And anyone and everyone's been in it and going for it. And that's not all. Institutions have also piggybacked Wall Street Bets positions. This rally the squeeze has been being blamed solely on Wall Street Bets. I think that's a bit too much of credit for them. I think it's part of that, plus institutions seeing this kind of being like vultures and really coming in and seeing that, guess what, this thing can go up exponentially because the short float is so high. We have institutions like Melvin Capital, different hedge funds, and many different short sellers trapped in here, and this could squeeze them out. And that's really what Wall Street Bets has been about, squeezing and hurting the institutional investor, okay, the institutions. But as a result, there's many, many, many institutions behind the scenes that you will never hear of that have made money off the backs of Wall Street Bets, Reddit, and those such types of retail traders. So hopefully this gives you an understanding of why that's occurred, because the short float is so high. There's still a potential for short squeeze if you go based on the current short float percentage, which is about 140%. Okay. Usually a highly shorted stock is roughly 25, 30, 40% short percentage of the float. GameStop is over 100 still, okay? That is insane. And you're probably thinking, Riz, how can you be short over 100% of something? If there's a limited amount of shares that are out there, how can you short more than what's there? Throwing snowballs at someone, but you have 5 snowballs, but you're able to throw 10. It just doesn't compute. How are you able to throw 10 snowballs at someone when there's only 5? Well, what happens, and many people don't know this, whether they're professional traders or whether they're new, it blows my mind. There's a lot of misinformation about this, is that brokerages are allowed to let individuals as traders and investors short multiple times over, meaning for every one share that's short, they're able to borrow it out to more than single person. So if you shorted one share, I could short that same share, okay, from the brokerage, even though there's only one share available. So there could be you, me, and someone else having shorted that share. There's 3 of us, okay, shorting now for every one share that's possible. Again, that's a very technical and detailed part of the markets, and why that's allowed is a different story altogether. But yes, brokerages are allowed to lend to multiple different people for every one share short that they have in their inventory. That's why you're going to see, and you are seeing, over 100% short float. Okay, moving on. Wall Street bets and individuals are saying to the moon and blah, blah, blah. Okay, I mean, the fact that it's nearly $350 per share is mind-blowing. Okay, this was a $20 stock just 3 weeks ago. Okay, as I've outlined for you. The question comes is, a lot of people are saying that, okay, the squeeze has yet to begin. And based on the short percentage float, that seems pretty accurate, right? If the short float is so high, if these institutions haven't been squeezed completely yet, they haven't been forced to buy back the limited supply of shares and close the short and effectively exit at a loss, well then that's yet to happen, right? Based on that. There's no right or wrong absolute answer in this. This could very well continue. We're in uncharted territory. This could very well continue. Or if people start taking profits, if people start selling the shares they own or closing the call options that they already have, this can then cool off the stock. And that remains to be seen if that does indeed happen. But leading to my next point, has this ever happened before? In fact, this is a black swan event. No one could have predicted this would happen. And if it would have happened to this extent, we see all the time, different biotechs and pump and dumps, they go up 100, 200% in a day or a couple of days, and then maybe they fizzle out. But very, very, very rarely do you have a company that isn't this biotech or isn't a really pump and dump type of play. It's a company that, has been traded, it has been around for 20 years or so almost, go up 1,700% in 3 weeks. Okay, it's very rare. But there has been one case, and that is Volkswagen. Yes, the German automaker. Not exactly the amount of, and in the scale of what's happened with GameStop, because it was a different market, but this has happened back in 2008. I'm going to go to the weekly chart again because we need to go back farther. All right, take a look at this. Okay, so Volkswagen back in 2006, trading at about $100 a share. Okay, it's rising. Remember, this is a weekly chart, so each candle represents a week. Don't worry too much because there's a lot of halts and a lot of problems back in 2008 with this stock, with Porsche trying to take over, and then launching a short attack, and then eventually the opposite happening, Volkswagen buying Porsche eventually. But that's another story. What you need to understand is something similar has occurred. Volkswagen stock, once the squeeze started, again, Volkswagen also highly squeezed, shorted at that point for many different reasons. And at that point, when the stock went from about $250, $300, and it just exploded. Okay, it exploded. If we go from an area of consolidation to peak, it went up about 400%. So it went to clearly nearly $1,000 or so, $1,100 per share, give or take. That took some time. Remember, this is weekly chart. That took some time. What also happened was it took some time to come back down too. All right, so that's a key criteria. Even if we do get an explosion and a continued explosion in GameStop price, it coming back down may not be immediate. Okay, it may also take some time. It depends on many different variables, of course, right? So this is one example that's happened in 2008. In fact, many of the people that are trading GameStop haven't even been around to see or witness a situation like Volkswagen occurring, right? So it's very uncanny. In many ways, markets do at some point repeat themselves, but know that this is a very black swan, very tail end type of event, to the extent that even someone like me, who actually started trading in 2008, who's doing so for over 13 years, even I can get it wrong. Even I can bleed, get hurt, and as a result, lose money by being on the wrong side of an insane, unexpected, uncalculable approach or move in the stock. So what you've probably been waiting for, my trade, how did that happen? How did I end up being short GameStop shares throughout this exorbitant rally? In order to do that, some dates and some numbers. GameStop, when it was trading around 20, it was picking up steam in the beginning of the year. Okay, it went from 20 to about 30s and then $40 to $60. Okay, remember, as this is happening, this is a weekly chart. I'm going to flip back to the daily chart to give you a better idea. Okay, so it's trading around 40. Remember, it's already doubled in a few days. Believe it or not, 100% increase in a couple of days is actually a lot. It may not seem like it nowadays, but it's a lot. It's very significant, and usually it's not sustainable. What's happening there as this is occurring, as an options trader, as someone who also shorts options to capture premium, I saw the implied volatility as being at around 200 to 300%. This was last week, the week of January 18th. Monday or Tuesday or so, I'm thinking, okay, well, guess what? This has gone insane. It's already doubled. Chances are this is going to fizzle out. Okay, this is a company, like I said, it's a dying business. Yeah, there's new board members, and there's restructuring and blah blah blah, and there's a new console cycle, but ultimately that's nothing structural, nothing significant has changed to cause a stock to double, right? And as a result, I had the thesis that this thing's going to pull back. It's going to pull back. It should pull back, and even if it doesn't, it's okay. I'll end up short the shares because I've shorted the calls, and it's going to pull back eventually, right? How high could it go? Statistically, when we do the options probabilities on this kind of trade, I mapped out less than a 0.01% occurrence. Not a 1%, a 0.01% occurrence of this happening. So when I say a black swan event, an event that you couldn't compute or expect in your wildest dreams, that's literally what we're seeing. And that has materialized. What I did was I shorted the naked short of the $60 call options. I shorted them. Okay, there's 60 strikes expiring on January 22nd, which was last Friday. Right? January 22nd, last Friday. Guess what happens? I'm now short. Not just one contract, not two, not five, over 10 contracts short. Large position sizing? Absolutely. Very large. But when you think about the percentage of probability of success, the 2 to 300% implied volatility, which is huge, it seems very juicy at that point in time. What I did was I shorted multiple 60 strikes. Okay? And remember, I had done that before too, the prior week, and they all expired worthless. So I'm like, you know what? I'm going to keep rolling this till the implied volatility dies down, this thing fizzles out. So I shorted in the middle of, or the beginning of last week, 60 calls, got some nice premium, and the stock's trading about 40. And I'm thinking, well, guess what? It's going to have to go up another $20, which is 50%. Can it go up another 50% after already doubling in the next few days? Statistically, highly doubt it. And even if it does, guess what? I'll be assigned and I'll end up short the shares. Eventually, they're going to fizzle out, right? But guess what? On Friday, the stock goes up, okay, from about $41, closes above $60 and $65 a share. Again, my naked short 60 strike call option, okay, is now in the money. What does that mean? That means because markets closed, I wanted to keep the premium. The 60, okay, the 60 call expiring on the 22nd is now assigned. And remember, like I said, over 10 contracts. All right. And remember, each contract represents 100 shares. I then, come Monday, get assigned 1,000 shares of GameStop shares at a price of 60. I'm short. That's my cost basis. $60 is what I'm short. What happens this Monday? What happens this Monday, January the 25th? Well, the stock explodes another, from close, another 50% that day. So right now, all right, I'm holding $60,000 worth of short GameStop stock at the moment markets open on Monday. By the end of Monday, this stock short position is now 90, let's just say about $100,000. So 60 to 100,000. The difference, okay? So I'm going to write here, $100,000 is what the short position is. I am at a cost basis of $60,000, right? Remember, 60 strikes, $60 strike. Again, if you are not familiar with options, you might have a bit of a hard time, but don't worry. There is a lesson in it for you. Okay, so the difference of that is $40,000. So I'm losing $40,000 on this trade in a day. Okay, not the end of the world. Okay, I've made millions over the years. I've lost six figures in different trades, nothing like this, but okay, that's fine. All right, let's see. I mean, it's got to fizzle out. I have conviction in my position. I have conviction in my thesis. A bit heavy on this, but I have enough time and enough liquidity, and I'm okay. Tuesday. What happens Tuesday after another 50% increase? This thing moves another nearly 100%, 92%, nearly 100%, okay, on Tuesday. At this point, this short is now about 150, let's just say roughly conservatively $140,000. Okay, that's the market value of this short. So guess what? My cost, I shorted at 60. The position is now 140. I'm losing the difference. What's the difference between 140,000 and 60,000? Do 60,000 minus 140,000. It's going to be a negative number, right? I'm losing over $120,000. Not 120, $80,000. $80,000 correction. Sorry. Now I'm thinking, well, what am I going to do? Okay, what am I going to do? Well, guess what? I'm thinking I'm going to probably cover. This is getting crazy. I'm going to take some off. So I take some off for a loss here. Okay. And how much did I lose? From 60 to 140 as a percentage on this. Okay. 125% on this trade loss. So that's how you can lose more than your initial trade amount when you short. That's prime example. Well, guess what? I still have a few contracts here. Few 100 shares here. And here we are today, Wednesday's candle. This is Wednesday's candle. I see this thing moving another 100% pre-market. In fact, from yesterday to today, Wednesday, January 27th, this thing closed up 134%. I'm not including the, after hours. It's up 134% since Tuesday, when it was already up a couple 100%. This was a line in the sand. Got to protect, risk management, yada yada. Close the trade. And as you'll see in this video, I'm just scrolling here in my brokerage. Again, I video captured it right off the screen so that you can see for yourself. And the total loss came up to over 106,000 or so, plus a few thousand that I lost before when I closed a little bit early yesterday. So that's a significant loss. Okay. I'm still here talking about it. Why am I doing that? Because it's a lesson for you guys, lesson for me, even though I knew not to do it, even though I went a bit too large. Guess what? The moral of the story is never ever short or short naked calls, period. You can short stocks, okay? Make sure your position sizing is fine, but do not short naked calls. Do not short naked calls. Simple, okay? What you will understand is that the loss is significantly not worth the potential gain of that premium, especially when it's in crazy stocks like this. All it takes is one move like this And it doesn't have to be 1,000% or 1,700%. It just has to be another 100%, another 50%. And that can implode your account because options are leveraged, right? Learn from this. Do not naked short calls. I can't really tell you any more simply. If you're going to short stocks, fine, short, but make sure you have a plan in place. Don't just short something and then get taken for a ride, right? Because if you shorted the individual stocks like Melvin Capital and Citron and blah, 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 they are losing over 1,000% themselves, okay? In fact, I think Andrew left of Citron's short, I think, cost is about $40 per share. Whether you short the calls and take delivery short, or whether you short the stock outright, be very, very, very careful. That's the moral of the story. It is what it is. It's not the first time I've lost over 6 figures, but it's fine. I'm still here. I've been doing this for 13 years. In fact, I share the ups and downs. I welcome it. It's a journey. It's part of trading. I'm sitting here. I could talk to you about it the day of, right? I'm not happy about it, but guess what? This is the nature of it, right? I'm very fortunate to be able to do what I do. And guess what? You have to continue to stay in the game, and you have to continue to trade if you're really passionate about it. If you're looking to get rich quick, maybe you made some money on GameStop and that's it. Otherwise, guess what? This is a very process-driven business. Trading really is kind of a business itself. So guess what? I hope you learn from it. I hope you understand kind of what's happened, my rationale behind it. Again, a big mess up. There's no denying that. I believe in extreme ownership, so it's no one's fault. It's not WSB or GameStop or short squeeze or the call or whatever. No, the onus lies on the person placing the trade, me, right? So learn from it. Even people like me who've been doing this for 13 years since I was a little kid, who's done tens and tens and tens of thousands of individual trades, who's made millions, okay? And I've documented transparently. I've shown my, days where I make 6 figures, but guess what? It's stupid to cherry pick. It's inaccurate. It's, I think, downright deceiving to cherry pick and only show the wins. So here I am openly showing the losses and negatives and drawbacks, right, of trading. So hopefully you've enjoyed this video. Thank you for watching. I appreciate it. I know it went a bit long. Please like, share, subscribe. Helps a lot. Thank you so much. Ciao.